2 we will have. Please remember, in the overview, we have in the previous session that theories of monetary policy transmission mechanism, we have neoclassical model, we have monetary quantity theory of the money. As you remember, money times velocity equals to price times quantity, meaning that money, if multiplied by how many times it changed hands, will be equal to nominal gross domestic product in the economy. So if you have production in the economy on the right-hand side, it should be equal to buy those goods and services, the amount of total money. For that reason, if velocity is stable and if the GDP of the economy is like the expectation, any increase in the money supply will create an additional price pressure in the market, so the inflation rate. Then we start with the monetary transmission channel. Those are interest rate, expectation, asset prices, and exchange rate channels. And implementing the monetary policy. Today's session will be the implementation of the monetary policy session. So let's turn back again the monetary policy transmission mechanism, asset prices, effects on those things. Then we will also try to cover, hang on a sec. I'm trying to take this side below. Yeah, now all is okay. As you see, the asset prices effects on business investment. So you should understand first, equity prices affect corporate investment via Tobin Q. The investment increases when the market value of a firm relative to its replacement cost rises. So what we mean by here Tobin Q, that you should keep in mind that Tobin Q in international finance can be defined as investment, a company investment increase when the market value of a firm relative to its replacement cost. So when you have a total value of your corporate company, this is the total value. If I divide this number to the replacement cost to build up those equipment from the beginning, if this ratio is increasing, then investment will rise because the total value of the company rises, or the replacement cost will be decreasing. It can be have in two direct. Corporate balance sheet effect. This is directly coming from the net worth of a firm affects the cost of capital. So if you have a firm, you will always have a balance sheet or income statement, right? In the balance sheet, you will see the assets, liabilities, and equities. On the left-hand side, we have assets, total assets, current asset, or fixed asset. Then on the right-hand side, we have short-term and long-term liabilities like loans, credits. And then we have our own capital, owner's equity. The total asset should be my borrowing plus my capital. So this is my balance sheet channel. And this balance sheet also be affected from the income statement via their owner's equity, because in those capital side, owner's equity side, I'm adding the previous year's net income to my capital. So income statement, total net income will be added to capital side as well. So the corporate balance sheet channel here, the net worth of a firm affects the cost of capital. So the cost of capital is directly affecting how much you want to make investment. So if the cost of capital increasing, you will decrease your investment in the long run. And the changes in collateral values affect eligibility for bank loan and thus the investment. So collateral value meaning this. Let's say Dr. Walshin want to buy a house from the market. Okay. Then let's say the total value of the house is approximately $2 million. Then let's say Dr. Walshin has 500,000. So he needs approximately $1.5 million mortgage credit, right? Because the total value of the house is 2 million. I have just 500,000 at my pocket. So I need $1.5 million more. So I'm going to bank. Then I'm applying a mortgage credit. Then the bank is asking me a collateral. Collateral means this. If you cannot pay the 1.5 million credit, what will I get from you? Okay, if you can't pay those money, how can I charge a fee to you? So in this schedule, either the companies bring a collateral like the government bonds, treasury bills, or the bank directly take the ownership of the houses until you fulfill all the payment of the credit. So during 10 years, let's say Dr. Walchin applying mortgage credit for 10 years for $1.5 million. During those 10 years, the house belongs to bank, not the Dr. Walchin, because house is a collateral for the bank. If Dr. Walchin does not pay their fee, then the bank will sell the house and charge their pool of equity. Okay, so this is collateral. What you bring in terms of your borrowing. Then if the collateral values change, the eligibility of the loans, if you bring a credible collateral, then the cost of capital will be decreased for you. But if you don't have valuable collateral, then you should apply the mortgage credit in a higher rate. Then the balance sheet effect. The bank's capital position and lending capacity declines when the net worth is adversely affected by declines in asset prices. The credit crunch. Credit crunch is this unwillingness of the banking sector to give the credit. Okay, so normally one suppose that if I have money and if I have enough salary, when I go to the bank, I can apply any type of loan. No, this is not true. If the banks have a worse and pessimistic expectation for the near future in the economy, even if you applied for the loan with a good salary and with a good collateral, bank will not give those money to you because of the credit crunch environment in the financial market. So please look at this sentence. Bank's capital position for the near future and lending capacity, because they know that if the near future in the, let's say in 6 months, banks should pay huge money to the market. So they need that money at their hand because they have obligation to pay those money. So they will not give those money to as credit for 10 years maturity with you, because if the bank say to you, bring that money after 6 months later, you will answer this question like this. I applied loan for 10 years, not for 6 months. But the bank should give that money in 6 months. So if this type of expectation and position in a financial environment, we call this as credit crunch. Nobody is giving any type of loan to any consumer or any mortgage application. And asset price channel also work in this style. The asset prices is here. Okay. If the asset prices is increasing in the company, the balance sheet will be rising, right? Because I have assets in the balance. In my balance sheet, I have lots of assets. And if the prices of asset increasing, my asset side in the balance sheet increasing as well. So external financing costs rising as well. And these will directly affect the investment output at the end. And this is the indirect channel. The indirect channel is coming from the expectation and confidence, as I explained here. If the bank have a decreasing lending capacity or have an adverse shock expectation in the near future, they will have credit crunch condition and will not give the money. So the expectation and confidence also affect the investment output. Why the investment output is important? Because investment and the cost of capital will directly affect the inflation at the end as well. And please look at this sentence here. This is a definition for a separal between the asset prices and aggregate demand. So the asset prices also affecting the aggregate demand at the end. So we should understand that if you will try to decrease the aggregate demand, because our main aim at the end to decrease the inflation is to decrease the aggregate demand. So if the aggregate demand should decrease, asset prices should be decreased in the end. So these are two mutual channels to affect each other simultaneously. Now, we are in a kitchen. Implementation of the monetary policy here. And I have always on the left-hand side an instrument. And with this instrument, I have a goal. Okay. My instrument is generally the policy rate, interest rate. Okay, these are my instruments. And while doing, these are reserve requirement, lending deposit ratio, outright transaction, reverse transaction, FX operation, direct controls. These are all my instruments. But what is the operating of this? How I can make operation with these instruments in the market? With the reserve money, market interest rate, exchange rate. These are the operating target of the instrument. Okay, I have instrument, but while I'm using those instruments, I have some operation. And these operation come from the reserve money, market interest rate, and exchange. And please look at this rectangle. This is implementation and the tactics. Okay, this hand, the left-hand side, is under the direct control of the central. Today, while we are saying the central bank, Federal Reserve, European Central Bank, Bank of England, Bundesbank, all are the central banks. And they have ultimate authority and control over these changes. So if the Fed saying that I'm increasing the interest rate, policy rate in the market, nobody can say how you will do this because Federal Reserve have direct control over the interest rate or reserve requirement. You will see the details in the coming slides, but all these tools have under the control of the central banks. Central bank can change all these tools in any direction according to their target. And now on the right-hand side, on the left-hand side, we have tools of the central bank. And on the right-hand side, we have the targets of the central bank. What is my target? I have generally the ultimate goal. Okay, all central banks have an ultimate goal in their operation. For instance, for the European Central Bank and Turkish Central Bank, when you enter the website of the central bank, it is written this. The ultimate objective of the central bank is maintain the price stability. Let me open the screen. Let me stop here and let me open my screen for you. Hang on a sec. Now I'm reflecting one of the central bank to you, and then you can see the directly what is happening and how those central banks put those targets. Here you have here, I'm opening the Turkish Central Bank. Please look at the top. The primary objective of the bank is to achieve and maintain the price stability. Okay, price stability, meaning that I have an inflation targeting regime. My main aim is at the end to reach a stable prices, controllable inflation. Okay, this is my aim at the end of the story. So now let's turn back to the slides. As you see, the ultimate goal can be price stability, but in the Federal Reserve, vice versa, they are saying the ultimate goal of the Federal Reserve is maintain the price stability and employment market. So they have two targets. First, price stability and inflation, and second, the employment condition in the market as well. So some central banks can also focus on the employment and growth condition in the real market economy, additional to the price stability, the inflation target. Then when we say the employment market, it is about the growth and the competitiveness. Some central banks can also say that I'm trying to achieve the competitiveness in the market. They can be their alternative. But what is important here? While reaching this ultimate goal, because it is not easy to reach these goals, they can put some intermediate targets as well. Okay. So if I have an ultimate goal at the end, it is not easy with volatile financial market indicators. It is not easy to reach these ultimate targets. So what should I do? I should put some intermediate targets here. These targets can be money supply, because remember the previous slide. What is money supply? M times V, money times velocity, equals to price times quantity. So if I control the money supply, if I achieve the control of the money supply, then I can control the prices. Because the Milton Friedman, the well-known monetarist economist in the world, saying that this well-known sentence, please think this word 2 times. Inflation is always and everywhere a monetary phenomenon. What does this mean? He is saying this. Inflation is always and everywhere a monetary phenomenon. What does this mean? This is directly saying this word. If there is an inflation in the economy, this is coming from the money. If there is no money supply in the market, there will be no higher inflation. Because to buy goods and services with higher prices, you should additional money, right? If you don't have that money in your pocket, there will be no inflation. So if I control the money supply in the economy, I can control the prices, price stability. Then if I also control the inflation rate, it is also, inflation rate also directly can be converted as the price stability. So if the inflation rate in a band that I have targeted at the end, that means I can achieve the price stability as well. And lastly, some central banks, like the People Bank of China, they can have exchange rate targeting. Why? Because they know that their prices directly affecting from import and export dynamics. Because China is one of the biggest economies today in purchasing power parity terms, bigger than the United States, right? So China is the biggest importer and exporter of the world. So if they import something, just think this. If Dr. Walchin increased his demand for bread, nothing will be changed. If I increase the demand for the bread, nothing will change about the prices of the bread in the market. But if the China change the demand for bread, all around the world, the prices of the bread will be double. Because China is too big to affect the prices. But me, Dr. Walchin, or any other people here does not have an effect to affect the prices, but the China, because when we're speaking about the effect of the prices, we are speaking this. Too big to affect the prices or too small to not affect the prices. China is sufficiently big to affect the prices. So if they increase their demand, their prices directly change because of the exchange rate pass-through effect. For that reason, they have around the world, we have lots of different exchange rate regimes. So the United States, Turkey, European Union, or North Africa, they have flexible exchange rates, meaning that the exchange rate value of my domestic currency will be determined by the demand and supply condition in the market. I will not intervene. I will not buy. I will not sell the exchange rate. Okay. The price of the exchange rate will be determined by the demand and supply condition. But China is not saying so, because this demand and supply condition just be effective in the flexible exchange rate. But in China, we have crawling peg. Crawling peg means China, Central Bank of China, saying that the upper bound is this and the lower bound is this. I will not let my exchange rate go above the upper bound and drop below the lower bound. It should be only flexible between this bound. Okay? If it drops the bottom level, they can start to buy. If it is going upper bound level up, then they will try to sell the exchange. So they will always keep their exchange rate in this band. When we pass to the why short-term interest rate as the policy instrument here, we can directly say that short-term interest rate, by the way, you should always keep in mind this value. I know these are really technical presentation because when the Federal Reserve Bank, let's say Federal Reserve Bank of New York or St. Louis, taking their step from the market, most of them are PhD students. Most of them are really, really brilliant students, and they know everything, mathematics, finance, everything. So these are the technical terms. I know most of the information can be melted from your brain, but you should keep in mind some words and some sentences. One of them is this. Central banks, we have, you know that central bank policy rate is 1 week repo rate. Okay, 1 week repo rate is the central bank policy rate. This is central bank interest rate. This is just 1 week maturity. So if we are speaking about the 2 years interest rate, 10 years interest rate, 30 years interest rate, these are the longer term interest rate. And the most important word you should keep in mind that central bank have only control on the short term interest rate. Okay? Central bank only can determine and have an effect and control on the short term interest rate. But while changing the short-term interest rate and expectation, they can also affect the longer interest rate as well. This difference is really important. Central banks have ultimate control on the short-term interest rate. They can directly determine. They can say that this is 1 week interest rate is 10%. 1 week interest rate is 3%. But they cannot say that 10-year treasury bill rate is, let's say, 5%. They cannot say this. But while changing those short-term interest rate, they can have an effect indirectly on the longer interest rate as well. Because, think this, if the central bank increase the interest rate in the short term, what does this mean? You will see the monetary policy mechanism, but this is a basic question. If the interest rate in the short term rising, what will happen to inflation? Inflation will go down because nobody will buy consumption goods. Nobody will make investment. And aggregate demand will decrease because interest rate, cost of capital is rising. So if the inflation is decreasing in the longer term, then the long-term interest rate will go down. So the mechanism works like this. Central banks can change the short-term interest rate subtle up in short term. Then they are decreasing the overall long-term inflation in the long-term horizon of the central bank. So please look at this words. Why short-term interest rate as policy instrument? Why the short-term interest rate is used as policy instrument, but not the longer interest rate? Because there are basic reasons for this, but 4 of them is this. Easily observable. Change send clear signal of change in policy because central bank has an ultimate control on the short-term interest rate. It can be easily observable. And financial stability. Avoid fluctuation in interest rate. Short-term changes is small, but the longer-term changes is volatile. So if I also trying to maintain the financial stability in the market, small changes in the short-term interest rate can really directly change the longer interest rate in the market as well. For that reason, I should focus on the short-term interest rate because their financial stability effect also in the market observable dimension. And lastly, the predictable effect. the transmission mechanism from changes in interest rate. The economy are relatively well understood because if I changed the longer interest rate, we have lots of long-term interest rate. We have 2-year, 10-year, 30-year, 1 year, even 6 months and 3 months interest rate. But when we speak about the short-term interest rate, we will directly speak about the 1 week report. Just 1 week maturity, and it is determined by the central banks in any country. But effective interest rate policy requires preconditions that are not given in the law PDR or Myanmar. These are some examples from our slides. Putting these places in the topic of regional workshop on monetary policy in next week, in next couple of weeks, I will put those implementation of the monetary policy as well. But here, you should understand how we are implementing interest rate. Okay, how we are changing the interest rate, then we will directly determine the real asset prices in the market. Hang on a sec. The key issues here: implementation of the interest rate policy by the central bank. Always keep in mind, central bank has ultimate control, full control over the interest rate, and linkage between short-term and longer-term interest rate. What I said, short-term is under control of central bank, but longer-term interest rate is not. But by changing the short-term interest rate, the central bank can have an indirect effect on the long interest rate. For that reason, you should understand the linkages, interrelation between the short-term and long-term interest rate as well. And now, please look at the flow charts here. It is directly showing an implementation interest rate policy. Overview. Please look at this one. Left-hand side. Open market operation, OMO. Previous class, we said OMO. What does we mean by OMO? OMO is open market operation. So, what we mean by open market operation? We have 4 channels. Repo, reverse repo, outright purchases, or outright selling. So, repo means this. Repo is the abbreviation of repurchase agreement. Okay, what does this mean? Central bank saying to the market that I will buy government bonds and treasury bills, to the central bank, and in return, I will give money supply to you. Okay, so I am buying the government bills and treasury bonds, then I am giving the money at that. But this is a repurchase agreement. So after the maturity, 1 week later, I will sell this government bond to you and you will give my money back. Okay, this is an open market operation. Or repurchase agreement can be in reverse repo as well. So if the central bank sell the government bonds and treasury bills and take money, then at the end of the maturity, he will buy again the government bonds and give the money. This is the reverse repo. But if central bank does not making repurchase agreement, but they are buying the government bonds and treasury bills for the long term, not short term, it is outright purchases. And if they doing the reverse of that, outright selling, meaning that after 1 week, I will not buy or sell. It will be in my assets in the long run. Standing facilities is a little bit detailed technical terms, so I will skip this because this necessitates a little bit financial literacy. But for the reserve requirement, you should understand that reserve requirement is like an insurance of the financial system in the central bank. Let's give this example. Dr. Walshin put their $1 million into the bank as deposit. Okay. Then Anna Lazarowska goes to the bank and apply for a credit. So you thinking that Dr. Walchin put $1 million, then if the Anna apply for $1 million, bank can give all the money. No, bank cannot give all the money. Because when the Dr. Walchin put the $1 million in bank deposit, central banks, as the highest authority in the economy, saying that you should put every deposit some percentages in the central bank account. Then they are saying generally 10 or 20%. Then if the Dr. Walchin put $1 million, the bank taking that $1 million as deposit, putting 100,000 to the central bank, then they can have only 900,000 to give the credit. Okay, so this is reserve requirement ratio. If the central bank saying that the reserve requirement ratio, I am increasing to 50%, what does this mean? If the Dr. Walchin put $1 million, then bank should send the reserve money 500,000 to the central bank account as the reserve required. So they will have just 500,000 to give the credit. Central bank can adjust how much money can be make a round circle in the financial market according to changes in open market operation, interest rate, and reserve requirement ratio. Then this effectiveness is coming from the pass-through. And as you see here, the OMO, the open market operation, and from the top, the reserve requirement can change the supply of the bank of reserves. Okay, because I am increasing the reserve requirement, then supply of the bank money is decreasing. Nobody can give credit. Bank deposit also decreasing, private credit also decreasing, and economy aggregate demand is also decreasing. So if I am increasing the reserve requirement or interest rate, economy is shrinking and inflation will go up. Okay, if I am increasing interest rate, reserve requirement, or standing facilities, this means that I'm increasing the cost of capital and cost of credit, then the aggregate demand will decrease, prices will decrease. This is the basic mechanism how the increase in interest rate will decrease the inflation. If I am increasing the interest rate, the cost of capital, the supply of bank credit, and the economy will go down, then prices will go down, then inflation will. Here, the open market operation. The central bank will buy repo. Please remember this word, repurchase agreement, repo. Central bank will buy repo bills to add liquidity to level of reserve deposit and sell reverse repo bills to the drain liquidity from the market. Today, what is the Federal Reserve doing? They are doing the reverse repo, right? They are selling all the government bonds and they are taking their dollars back because they give all dollars during the COVID crisis. Now they are selling the government treasury bonds and they are taking their United States dollar back to their bank. This is reverse repo. And how much liquidity is provided or drained through OMO? It is dependent on target. So if you know the money supply, you can calculate the price level in the economy. So according to your target at the end, you can adjust how much liquidity you will give, how much liquidity you want back at the end. This is the quantitative target, reserve money, and this can be directly calibrated by the open market operations. An interest rate target, it can be open market operation again, needs to meet the liquidity demand in the market that materialize at the targeted interest rate. And here we have the OMO and the interbank market. So OMO, open market operation, is the central bank decision-making process, but we have the private banking process as well. So the commercial bank lend reserve to another to meet liquidity shortfall. So if I am increasing the interest rate and if I am not giving the money to the market. If, let's say, bank A needs the money, but central bank does not give it the money. Normally, central bank is the lender of last resort. If the money cannot be found in the market, central bank will give the ultimate liquidity as a lender of last resort in the market. But if central bank says that I'm not giving today any money, but bank A needs money, right? So they are going to the bank B, interbank, not the central bank. They are going to the bank B and bank C to borrow the money. And liquidity can be changed between the interbank situation, between the market now. And rate is market determined and governed by law of supply and demand for reserve. So if the central bank does not give the money, then the liquidity in the market can be changed between the interbank participants. So in this way, central bank can control the supply of reserves and determine the interbank, right? Because the cheapest money is coming from the central bank, and if central bank does not give the money, then the interbank ratio will be determined by the central bank by not giving any additional liquidity in the market. And the reserve ratio, a few minutes ago, I mentioned this reserve ratio issue to you. Reserve ratio is, please look at this definition. Another instrument is the required reserve ratio to control the level of system-wide liquidity. When banks must keep a certain amount of reserves for each dollar of deposit, what I said, Dr. Walkin put $1 million to the bank as deposit, but central bank at the beginning saying that how much money you should bring when you accept deposit. So if bank A accept $1 million deposit from the Dr. Walshin, in that second, they should put, let's say if it is 10% reserve requirement ratio, they should put $100,000 directly to the central bank account. So banks must keep a certain amount of reserves for each dollar of deposit. And the total amount of liquidity available for banking lending, purchase of securities, and etc. will be limited. So if central bank, let's say, change their decision and today they are saying that reserve requirement ratio today is 70%. What does this mean? They will take money from Dr. Walchin as $1 million, but they will put those $1 million, 700,000 to the central bank, and they will have only 300,000 at their hand to give the credit. All the liquidity can be determined by the central bank now. Okay. Hence, this instrument complements those open market operations that are designed to drain the liquidity in the market. So the main instrument, main policy instrument is the open market operation. But after the open market operation, if I also drain the liquidity from the market, I can also use the reserve requirement ratio as a complementary tool here. And from the previous week, we have pass-through from policy rate to money market rates. Pass-through is this. If I am importing any products and if my exchange rate depreciates against the United States dollar, then my money, my domestic currency, loses value. And the imported products prices will rise, right? Because I'm importing in terms of United States dollar. So if the United States dollar increasing, the import price will increase, then domestic price will increase. This is the pass-through effect of import prices. Import prices pass-through effect to the domestic prices. And interbank rates here and the money market. The money market, debt market with maturity less than 1. Okay, money market meaning this. Okay, if the maturity is less than 1 year, I have money market. If maturity is higher than 1 year, I mean financial market, not in the money market. Money is more liquid, okay? But financial market less liquid. An interbank market here steer the rates in the broader money market through the arbitrage condition. Arbitrage means I am buying the cheaper and I am selling the expensive one. I am looking at the market condition and I am adjusting my position according to the cheaper and expensive option. And this is the arbitrage. If interbank market interest rate, please look at here. If interbank interest rate less than the money market interest rate, so I will borrow in the interbank, right? I am making arbitrage. Buy the cheaper and sell the expensive. Always arbitrage condition work in this direction. Then, if I buy from the interbank, then I can sell and lend this money in the money. Or if the vice versa, if the interbank is higher, then borrow in the money market, then sell in the interbank. And the last 2 points here, why the expectation is really important in my monetary terms and while changing the interest rate decision mechanism, why the expectation is really matter for me. Market rates don't always move in the tandem with policy rate. Expected policy changes are incorporated in today's prices. So policy changes will put an expectation pressure on the consumer and investor that prices, cost of capital, exchange rate will change in the near future. This is expectation. Expectation about real equilibrium interest rate can change as well. So an increase in the productivity would increase the real equilibrium interest rate as well. And inflation expectation goes up, then long-term rates goes up. Why? Because if I expect in the near future inflation go up, I will say the government that your 10-year return today is 2%, but inflation goes up to 2.5. So to compensate my loss because of the inflation, you should increase your long-term interest rate. Do you understand this mechanism? This is really important. If inflation going up, people lose money in the long term. So they are saying to the government, please increase your long-term interest rate because I am losing money because of the inflation. So you should give higher money to me, so not to lose because of the inflation. And if the maturity premium or exchange rate is increasing, the longer term rate are also affected. If I have a maturity premium problem, then I will ask government again. At the end of the maturity, I don't know which type of condition I will face with. So you should make me sure that I will not lose the money at the end. This is also affecting long-term interest rate. And the last slide from my side is this. Factors that are impeding the interest rate pass-through effect. The first one is nature of the existing contract, floating versus fixed interest rate. So interest rate can be floating in the interbank market, but it's fixed in the central bank side. Financial market development also really affects. If you don't have a deep financial market, then any sell or buy side condition will directly affect anything with a sharp condition. But if your financial market is sufficiently deep and it has differentiated products and instruments, then any type of small shocks will not be affect the longer or short-term interest rate in the market. And competition in the banking sector. So if you have lots of different banks, deposit, investment, loan, credit, if you have this type of different banking sector, they will have a competition. They will have a competition on interest rate and mortgage credit rates. So they will not, one of them will not be directly affected the overall economy or interest rate. There will be have a competition there as well. And the central bank credibility. Central bank credibility is everything. This 5.5 can affect the everything. So the Federal Reserve or European Central Bank have a really credible central banks all around. Whatever they say, they will always support those policies and they will change their credible policy by decreasing inflation and with forward guidance, just with words. Even don't use the mechanism, even don't use the instrument. Because they have credible central bank, just with saying in the monetary policy committee, without changing anything, they can affect